Greetings, everybody. This is Jeff Scott. Happy Sunday. Happy May Day, May 1st, 2016. And welcome to this week's edition of my top-down review. I titled today Selling Season because it certainly felt like that on Friday, as well as the fact that it's impossible to ignore, although not always to believe, everything you hear that the sell in May and go away selling season starts on Monday. As always, if you have any questions or have interest in my upcoming meetings, please contact me at hgsidoc@gmail.com. Disclaimer, this is for education purposes only. Anything I recommend is in the spirit of education and should not be considered investment advice. I'm a doctor, not a broker, and I can assure you over my years in medicine, I learned how to lose money by talking to other physicians, so take that with a grain of salt. I am not affiliated with any software vendor or trading company. The tools I demonstrate are those that I use in my daily trading, and I have paid for all the tools I demonstrate. And trading involves risks, and you alone are solely responsible for any investment decisions you make. I always like to thank my influences and to really point out that I'm not, in medicine, a scientist is the one that creates the data, and a smart physician learns it and applies that data to taking care of their patients. I'm the smart physician, I'd like to think, because I'm not saying that I'm the creator of what I do. I've tried to learn as much as I can. Yes, there's a couple of indicators that I'll take credit for, but for the most part, I've relied upon the knowledge. I started with O'Neill and how to make money in stocks and CanSlim, which was improved and modernized, I believe, by Morales and Catcher, and then made electronic, scannable, searchable, and some added improvements by Ian Woodward and Ron Brown. This is my buddy George Lee from Canada, who's also a great trader, and I've learned a lot from him. We've shared the podium at many live sessions. Now, if you listen to Morales, who's truly a disciple of O'Neill, worked for O'Neill, he'll tell you that CanSlim's not working. I'll tell you as well. Right now, CanSlim is, there are always stocks that work no matter what pattern or what system you use. But right now, buying breakouts and growth stocks isn't what's leading the market, and I'll show you some evidence of that. However, what O'Neill teaches is a great foundation, I believe, and maybe someday CanSlim will come back in vogue. There's no question in my mind that trading strategies change and evolve over time of what's working and what's not working now. Now, saying that, this guy here, John Person, who's become a friend of mine, but he started as a mentor, teacher, lecturer, and author of books I wrote, and also developer of software tools that I've been using since probably 2007, I think I checked. But John, the interesting thing is his system of indicators and analysis doesn't care about whether it's what's in vogue, growth or value. And what I really like about John's stuff is that it addresses what's working now. He hasn't changed what he does since the 80s, and I find it a great way of taking stocks that I might find fundamentally, scanning, hearing about, reading about, and knowing when to buy and sell them, where to set my stops, position size, money management. And he's just a great guy and great teacher, and I highly recommend, if you haven't been to one of his live seminars, you need to. And then Van Tharp really wrote the book on position size and money management. So I've read hundreds of books, literally. I've read many of the masters, if not all the masters, not all their books, but something from many of them. And really what stood out to me was what I've learned from Ron and Ian and also from John Person. I have bought too many programs. I purposely hide my desktop so I don't have to explain to anybody why I have things that I never use. I'm sure on this video that I'm the only one who has fallen for the hype and bought a program and never used it before. And it's a personal problem. I have to have a real-time platform. I use TradeStation and Thinkorswim. I like the charting, some of the scanning on Genesis. I love their customer support. I just send them an email one day. I'd like to make it a personal indicator of XYZ, and then a day later I get back the code. They don't charge me a penny. For analysis, as you see, I use a lot of HGSI and EdgeRater. And then I like to supplement it with a seasonality program. I'm not going to take sides. I use and have paid for all three of them, and then a number of websites. Here's highgrowthstock.com. I point this out for a couple of reasons. I don't get paid by them. I do this mostly as friends and family in that I want to support the product. I want to support new users. I get, again, no reimbursement, no commissions. But I wanted to point out a couple of things. You get a free trial if you've never seen the program before. I think it's 30 days. And they don't even ask for a credit card. In this day and age, it's very nice. It's kind of strange, but it's a good thing. If you go under investing strategies, you'll drop down a menu. You'll see my name there, and a lot of my webinars in the past are there with little explanations of what they are, and they're all free to download. I also want to call out again that John Person is having a seminar in the fall, September 24th through 26th, down here in Palm Beach Gardens. It's a lovely place. I kid you not, it is paradise. That's why I moved here. Now, if you are coming by yourself, the Hilton Garden Inn is, as far as Hilton Garden Inns go, it probably should be a regular Hilton. It's just a wonderful hotel. If you're thinking about bringing a loved one, spouse or child or friend or whatever, you might want to look at the Marriott on Singer Island, which is about 10 minutes away. It's on the beach. It's where I hold my meetings, and September is off-season. So for just a little bit more money than the Hilton Garden Inn, you can get an amazing place on the beach. That is a meeting that I'll probably have a couple of hours to speak at. It's John's meeting. I'm there to help him take a breath. But I will hold for HGSI users what unfortunately appears to be the only live meeting for HGSI seminar this year. I'll hold it on Friday, or at least this half of the year, September 23rd. It will be from 9 to 5 at the Palm Beach Gardens Hilton, I believe. I've had 4 people sign up already or indicate they will sign up. I need probably 8 to break even, so I'm hoping to get 4 more people. I will, personally, I've already committed in my mind. I think we'll have no trouble getting to 8. And as people who've been to my meetings know before, I give it all. It'll be nonstop. You'll have a nice lunch, and you'll go home with the videos and the handouts of all the things that I do. Please contact me for more information. What I did is I actually dropped the price if you're attending John's seminar from $400 to $300. Again, I don't do these, as people know who've been to my meetings before, to make money, but I don't want to do them to lose money either. Stock patterns are cyclical. I always want to know where I am, and I laugh because I don't know where I'm at right now. I think uncertainty is still here. We've just had this gigantic run in parts of the market. I found over 100 stocks with over 100% return since the market from February 11th. That's pretty bullish. And then again, I see that a lot of sectors are underperforming. Gosh, look at biotech. That was a dog I picked last week, LABU. So maybe it really depends. The market itself might be uncertainty, and some things are working, some things are not. But you really got to know where your index, your group, your industry, and what the overall market is. And it's tough. Something that I learned, I reread Brad's book again about speculating. The Perfect Speculator, I think it's called. It's actually a super easy read. It's on Amazon. It's like no money. And he makes some great points. You don't always have to be in the market. You don't have to buy every day. He actually suggests that you don't even look at real-time quotes during the day. And frankly, I don't trade every day. I look at the market every day, that's for sure. And I may trade around certain positions and put some protection, especially around earnings time. But I don't feel bad if I don't buy or sell something every day. It's actually a nice read. And then if I actually knew where the market was, I would tell you where I would be taking different trades. Since not knowing is the same as uncertainty, I think being in cash, taking smaller positions, and maybe looking at selling premium. I'm still playing to the long side and to the short side. I did take some contra ETFs last week, and I did collar some positions. Of course, I put a collar on Amazon. Fortunately, I took off the short side so that I didn't get taken out. I took it off on. you know, the collar, just to talk about that, was I'm in Amazon since about 450. And I don't want to sell my position. And as I mentioned before, I actually wrote it down by selling calls against it and buying some puts to protect it. So what I did is I bought a put spread. So I bought a put underneath the price, pretty well underneath the price. Sold a put way beneath that to help defer the cost. And then I had sold a call that was out of the money. And then the stock pulled back before earnings. And my call that I had sold now was worth about $1. So why leave $1 on when I could get a big pop in the stock? So as you know, Amazon had a great move, but I mean, my put position lost money. I made a lot of money on that move, but I would have made more had I not bought protection. I buy life insurance and health insurance. I'm not looking forward to using those either, and you just have to gauge your own personal opinion. So I do like protecting positions before earnings, especially with what happened with something like Google, Intel, etc. But I've actually have some naked puts on right now, or not naked puts, where I bought puts, and I have sold some out of the money calls on certain positions and got some naked calls. So I've started to take more and more of a short-sided position, but I'm not saying that I'm totally convinced we don't have another run up, and I still have long. So put that all together, and you're scratching your head, and you'll say, he doesn't know what's going on, he's uncertain. Yes, I'm uncertain, but I've started to hedge my longs to protect them, buy insurance, and I'm taking smaller positions and taking profits. So let's look at why I'm confused. Here's the sector review at end of day Friday. So what do I see? I see that utilities, which is a defensive group, has increased the last couple of days. They had a great week. Staples and discretionary are sort of mixed here. Healthcare is not mixed. Healthcare sucks. The airlines suck. Home builders got killed. REITs got hurt. Casinos got hurt. Financials got hurt. Oil services strong, I think, driven by some positive earnings and the fact that we're getting to a point where the rig count is getting so low that eventually it's going to overshoot and they're going to be busy. Gold and utilities, clearly the strength. As you know, I like to look at the markets on a daily view, and for the next 3 pictures, the upper left-hand corner is the E-minis, the S&P 500 futures. In the middle are the NQs, which are the NASDAQ 100. So it's not the NASDAQ, it's the big stocks. The next one over is a YM, so that's the Dow futures. Down here in the lower left is the TFs, the Russell futures. We have the VIX, and we have the dollar. And I know it's sometimes hard to see this. So what are the key points here? On the daily charts, we've come up a long way from our longs, at least on the indexes. Clearly, we showed weakness last week with PPS sell signals on 1, 2, 3, and 4 of all of the daily charts. From the bull perspective, we're still above the 50. The 17 is in green, the 50 symbols in yellow, the 200 symbols in red. So the 50 crossed above the 200, which some people call a golden cross, and other people point out that by the time that happens, most of the move has been done. Duh, that is correct here. We'll see if there's more move to come or not. But from the bull perspective, at least the S&Ps are well above the 50. Not on the NASDAQ. The NQs got hammered. I mentioned Google knifing through. They're 50. This better heal quickly or this market may be in trouble. The YMs broke above the 17, but they're well above the 50. Again, golden cross everywhere. The YMs, which started the furthest down and had the biggest move, actually holding above their 200 here as well. Still well below, had a big move. The 17 and the 50 here, unlike these others, because of the profound bad market we've been in over the last several months, are still below the 200 in recovery phase. And this blue line is actually the 1,000 daily moving average. The VIX started to stir. We'll get better views of that later. And the dollar pummeled. If I push it out to weeklies, the story continues that, again, the dollar is clearly in a weakening state. The VIX may have stirred, but it's still quite low. And Are we in this long-term topping pattern and just pulling back up to a head and shoulders and going to break down and go much further? I think that's not an unfair question, especially in this time of year. So as I start to think intermediate, a little bit longer term, I might be getting a little bit more bearish here. And then if I look at monthly, does it help me out at all? And again, it sort of, to me, calls out that this level here, 21, 54, 34, whatever it is, I should know that number by heart, it's tough to get to. And after this dramatic run over a number of years, it kind of looks like we're sort of chopping around here in a topping formation. And as I used to put in one of my charts, it takes a long time to top. Bottoming are events. Pull back and you're done. Pull back and you're done. This topping thing just takes longer and longer. And then this here is another way of looking. If you look at the rows, 1, 2, 3, top rows daily, then weekly, and then monthly. And then I've got the same things here. I've got the E-minis, the NQs, the TFs. I've got the NYSE and the YMs. And what's my point here is which one is performing the worst, or which ones? Probably right here, the NQs. NQs have rolled over, and you'll notice that right now, at least on Genesis, the only weekly sell signals in the NQs. Hard for me to believe that this market could go to new highs without getting participation with some of those generals in the Canary index. And can Amazon and Facebook make up for the others? Got some Tesla earnings this week. You also had the Priceline CEO get terminated for fooling around with an employee. Never a good thing for a public company. Fed inaction and the Bank of Japan decision loom on the dollar as rates hold steady. It was an interesting week. I thought that the dollar was going to start to make a move, and then the Fed held, which wasn't a surprise. And then the other thing that happened was the Bank of Japan did not ease when everybody thought they'd ease and go further negative, and that led to the yen racing up higher and the dollar dropping. So rates didn't really do much this week. AD lines, you can't see it here, and we just talk through it. Notice on the right, this white line here is making a new high. You've got a lifetime high on the Russell 1000 on the AD line, still going higher, while the Russell 2000 looks like the indexes, it seems to not be able to take a new high and rolling over. That concerns me and makes me wonder that these small stocks are going to start to weaken again, and perhaps they're going to leave the market lower. And then what about my stocks above the 200-day and the 40-day? The 40 days have turned back down from their highs up here, but still the vast majority of stocks are above their 40, and we're now about 60% of the stocks are above the 200. So whatever oversoldness this market had is being worked or has been worked off. If you look at the 3-month new high or 13-week new high, new low index, we were at a 10-year high. We've backed off of it as the market has pulled off some of its recent move. The McClellan is sitting sort of in neutral at about -20. I don't know what to do with this except when it's at the extremes. When it's at the extremes, I expect the market to reverse. The buckets, we came off an extreme last week where we had 71% were above the midline of the S&P. What this is taking is all the 1,500 or 1,503 stocks in the S&P 1,500, dividing them up in 10% deciles of the Bollinger Bands, adding one below and one above for a total of 12, and then asking how many stocks in that index are above or below the midline of the Bollinger Bands. We're at about neutral. And you could see there really isn't a pattern here. We look for exuberance to the downside when you get to 15, 20, 30% of the stocks below the lower band or on the upside here. So I will take out overbought. I missed this, and I'm going to make that neutral. The Hindenburg is a signal that's sort of in the folklore of it has to do with 4 or 5 different events, and if they all occur, then it predicts that you're at risk of a large correction. Over the last 50 years, except for this last one, which I guess wasn't that big of a correction in the scope of things. We're already back almost to where we started. There hasn't been a major correction without a Hindi. About a quarter of Hindi signals are false. I mean, are real. The 3/4 just represent a very small move. And I think to explain in lay terms what happens when a Hindi fires is the market's usually at a high. Could be a double top as we saw in 2007, 2008. And the professionals have decided it's time to get out of the market. While us small guys still are buying. And so you get a lot of volume. You have a lot of volatility with lots of new highs and lots of new lows. And the market keeps getting higher, but the McClellan starts to drop because of reducing breadth or participation. And ultimately, the Hindenburg fires, if you get multiple Hindis in a row, you might see the market roll over. So this is a edge rater analysis. I just hit one button, and I could see down here that I've got, of the 4 things that I need to have happen, I've got only 2, so there's no Hindi in sight. There hasn't been a Hindi in months. This is the Ian Woody indicator, and it's sort of a buy-sell thing. We look on multiple indexes. Hard to read here, but really what matters is we had this very nice move up in the markets. We look at the third set here as the Woody indicator, and then we had a shot across the bow of the bulls with a big kahuna to the downside. That didn't roll the market because we actually had some reversal kahunas here, but you can notice we went from a solid green to some yellows, and then we're starting to see more kahunas. Kahunas are momentum moves to the downside or upside, red to the down, blue to the upside. And now we're starting to flip to seeing, especially in the NASDAQ 100, we're starting to get sell signals come in the market. So this market over the last several years has been led by certain stocks. We call them the Canaries, and these would be the Facebook, Netflix, Google, Apple, Amazon, Priceline, LinkedIn, and Tesla. And this is something that has been brought to us by Ian Woodward. We make our own index of those, and we use it as a tool to help us determine where the market is. Now, I just want to back out a second and show you my lovely wife just brought me a present. Thank you. Why the Canaries, when I talk about them as leaders, I got to take off my index. That chart doesn't do them justice that I showed you because it's a short-term chart. But here's the Canaries index. I got to calculate it. Hold on a second. I usually remove the filter. I filter out indexes, so I don't always see them. Let's see that calculator. All right. So if I step out and look at a weekly, for example, there's no question that for a period of time, 14, 15, and that's not even long enough. Let me go look at the daily. Let's bring it together. All right, so let me hold on one sec. Let me play with that index a second. I'm going to use these settings. Use market weighted. We'll go back to, let's go back to March 2009. 03. I'll make that, just make it February 28th, 2009. Tools, build index. As you can see, what I wanted to show you was on this move of the market, starting in 2013, up to its peak, these Canaries really did leave the market, running from a low to a high here in 118 periods of 151%. During that time, we would look at the performance of the Canaries, and that's over 150 weeks, so that's 750 days. That's 4 years almost of trading. We would look at these Canaries on a daily basis to get an understanding, or a weekly basis, of what the leadership was doing and then hoping that would tick us off if the market was going to turn. Go back and look at December for some comments about that here in one of my videos. We failed at the 200. Even though we had a kahuna on Friday, we're weak here. And if these Canaries can't turn around, I think that it really says it is time to sell in May and go away. If you look at these stocks, it's an interesting story. Facebook, stellar earnings, blowout, doing well. In fact, what the heck? Let's do it the right way. Let's talk about the Facebooks, these one at a time, and then we'll go back to my presentation. Here's Google. Daily chart, clobbered on earnings up here, big, massive sell-off. Highlight that day. Lost 40 points at the close, minus 5%. From here down to here, I'm not going to take the time and draw it, but, you know, sort of another 40 points down from there, and it's now sitting, I got to get that, hold on one second. Okay, I'm back. Sorry about that. So Google pulled back to the 200. Boy, this is a line in the sand. If it breaks down below the 200 daily moving average, is the next stop getting down to 672? Yeah, that's a 50 weekly moving average, but that doesn't say good things about the overall market if we can't hold here. So this is a pretty big point, I would think, for Google. That's only one day's move to get to 672. Amazon, stellar earnings report. Stellar earnings report. When I said I'd buy puts on Amazon, I was thinking I'm pulling back down to here was my risk. So I buy puts in this range. I sell something down here, and it's just to protect me. I didn't buy them to make money on them. I bought them to prevent loss. Then you sell a call up above the price. And as I said, I covered the call before earnings came out. Earnings per share growth, this is the quarter we just had. It was just a kick-ass, excuse my French, quarter for Amazon. Like Facebook, they gave back a little bit. The day after the earnings came out, they have a high multiple. I think Amazon goes higher. I'm long Amazon. Apple. Here's what happens when a stock breaks through the 200-day moving average. It fails when it tries to get back. It fails again. Apple looks like it's going nowhere. Facebook. A lot like Amazon, it had more of a give back on the day of earnings. I think it surprised a lot of people who had thought their advertising was slowing down and that they might be having some issues. Everything's green up here at Kahuna. Facebook looks great. I think Facebook goes higher. And I think that this was a very nice day on Friday with the market weakness and Facebook actually closing up 0.75% on a bad day. LinkedIn had good earnings. It actually traded up to 140 after hours. Earnings don't look that exciting going forward, although they did beat on most of their parameters. So LinkedIn, deep in its pattern, but even if it got close to the 200-day moving average, that would be a huge move. Notice the weekly bongo here is red. On Facebook, it's now turned green. And on Amazon, that's the Canaries, by the way. On Apple, its weekly's red. And on Amazon, the weekly's green. And that really, to me, has been that weekly bongo, a great buy-sell indicator. Speaking of the weekly bongo going red, you can see Netflix went red here. It failed at 200 here. Failed it here, failed to stay above it on a retest. Netflix also looks weak and looks like it might be going lower. Tesla, earnings out this week. Not a strong-looking stock, but Elon Musk has a way of making people happy when he talks, so we'll see if he can talk up the stock. And Priceline, earnings are out this week as well. I noticed they mentioned that the CEO had some issues that led to his ouster. Sold off a little bit on Thursday and came right back up. Sorry about that. I got pulled away for a work-related issue. So here's Priceline. It'll be interesting to see how that does. As I said, earnings out this week. So go back to the presentation, and I bet I've told you why I'm concerned. We got some winners, we got some losers, and we got a couple to come. It'll be interesting to see if we can build on Amazon and Facebook, or are we going down to retest the most recent lows. Back on March 6th, I looked at the early things out of the gate, and I picked some winners. And I created an index, and that index, if you consider that I put it together somewhere around here, based upon what the early leaders were, that index ran up for about a month, and then it stalled. And now that index is starting to break down and close below the 200. Another early warning sign that this market is rolling over, or is it just market rotation? Let's talk about market rotation. I've updated this to include this week's work, and this is a chart, and EdgeRate is such a powerful analytic engine. It allows me to put in a spreadsheet, and basically there's some pre-programmed questions. That spreadsheet I put in was dated February 11th, and it had all the fundamental and price data and technical data for the entire market universe on February 11th. Then I can look at the end of the month of April and say, show me how things behave based upon their characteristics on February 11th. So you look at this thing here on the left, and what you typically see is that the curve goes from the left to the right, lower left to upper right. I always ignore the head or the tail because there's very few stocks there, and I look at the middle. This does not look normal. In fact, based upon this picture, it tells me the worst stocks in the market by ERG had the best performance. When is that normal? ERG, EPS rank. The lower your EPS rank, the better your performance. Relative strength. The lower your relative strength on February 11th, the better performance to date. And group rank really didn't make a big difference, but the highest ranked group certainly didn't outperform. ERG is a combination of those three. Why do I say CanSlim's not working? Because ERG is very much a CanSlim-based phenomenon. How about accumulation distribution? Those stocks that we're distributing on February 11th have had the best move to date. And then the boxes were positive everywhere because everybody, all groups responded. Boxes have to do with earnings quarterly and annually. And the highest earnings are box 1, 2, and box 7 is a turnaround. They certainly didn't underperform compared to others, but they didn't really differentiate. So then I thought to myself, you know, that universe of 8,000 plus stocks at HGSI probably reflects a lot of penny stocks. And maybe it was just the penny stocks that bounced off the bottom. Nobody has a 600% return. And I was right, so I redid this, and I only used stocks above $2 and 250,000 shares. Guess what? It doesn't change. Yes, you eliminate some of these crazy numbers up at the top. But for the most part, across the board, this rally in the market, which is not quite 3 months, about 2.5 months, was very powerful and very strong. Again, EPS rank, relative strength rank, the worse you were, the better you did in the rally, and distributing stocks outperformed. This is clearly a junk off the bottom rotation. Now, how about this chart? This is based upon data taken on February 11th, where they were on February 11th to where they were at the close on Friday in the percent return. This is 100 stocks, the top 100 returns, with each of which with over 100% return. How many of you, when I said lottery ticket, Techminco, TCK, actually listened to me? I don't blame you if you didn't. I mean, I'm a doctor, and I already said that doctors aren't good at stocks. But somewhere up here will be TCK, not even one of the best. All right. Oh, it got killed because of price when we started. Never mind. TCK was one of the ones that's up about 300%, 200% since I mentioned it. But what can you tell about, here's Freeport-McMoran sits in the same industry group as TCK, is up 186%. TCK got stripped, I believe, let me go look. I was going to tell you something, now I got to go find it because I don't want to look stupid. So I had, this is the market off the bottom with no price or volume limits. Well, I know it's here somewhere because I looked for it before, so I find. There it is. Told you it was here. So it started at, maybe I'm probably somehow it got dropped. It must have been volume, I guess. TCK has run from 369. I told you about it was about 4 to 1225, a 232% gain over this period of time. So the point here is, I mean, believe me, I can pick bad stocks too. Just look at what I did last week. Hint, hint. But the point here is that we've got just massive returns, not just on teeny-weeny stocks. And look at where they came from. Oil and gas, a rare biotech, metals and mining, oil and gas, metals and mining, steel, anything that rings out about this, these are the things that really underperformed. So fascinating. I hope you owned some of these. I hope you owned a lot of them. Know your news and EPS dates. Last week was a big news week. We still got plenty of things this week coming, including the unemployment report on Friday. This may be a moving market week. In addition, I'm not even going to go through these. There are 3 zillion earnings reports coming out. As I've said before, and I thought it was important enough to put it in quotations, it's a judgment call to hold stocks over earnings dates. It is bad judgment to not know when your stock's earnings date is scheduled. Market thoughts. Indices turned down on the BOG Inaction. Economic data remains mixed. Employment strong. Still do not feel that there's a rush to raise rates. Major market indices, I added the word failing at resistance. EPS season continues in high gear. We saw with Amazon and Facebook that they can make a huge difference. Oh, son of a gun. Sorry about that. EPS season, again, high gear. Seasonally strong, but over the last few weeks, but the sell in May loom in traders' hearts and minds, and how long can junk off bottom lead the market? Market meter. This is something I look at every day. I try to automate it. Eventually I will, where it pulls information both on persons indicators and the elder impulse indicator. The impulse indicator is the color. The word is the person buy signal or sell signal. When the indicator is green from elder, says the buying window is open. When the indicator is blue, he says you can buy or sell or hold. And when it's red, now this has been a challenge. That was another interruption, but I'm back. So this is my market meter. And as I was telling you, I look at the red, green, and blue from the elder impulse indicator and then the buy-sell signals. And I'll show you how I get them in a few seconds. But every day I put this out there and I look at it. And here I'm showing you week to week. Why? Because this tells me a big story. The market is definitely weakened on the short term. We're starting to even see on the NASDAQ, as we know, led by the NASDAQ 100, some weakness on the longer term. But that blue bar there says it's not all over. I look at the intermediate term, and again, the NASDAQ's weak, but this market hasn't totally rolled over. We still got buys in blues on the weekly. I look at sector rotation, where right away I can see, let's start on the bottom, discretionary has now got a red sell on the daily. So short term, their discretionary is weak, despite the Amazon move. Healthcare went from a buy to a sell, some weakness there. Utilities, which had been weak as the general market was improving, actually went back to a daily buy. So it's sort of long-term monthly in a buy, daily in a buy. The intermediate term is still in a sell. Staples, which like utilities had weakened, have now picked up some. Technology and industrials are weakened. And financials, at least short-term, weakened. So where is the money going? Energy, still a buy across, although it did still blue here, so it's mixed on the daily. Staples, although weaker, it's still a buy. And utilities, not exactly growth-oriented places. So as usual, my agenda, top-down review, charts of the week, etc. A little bit about the chart of the week, and I should go to full screen here. I apologize. This is for educational purposes only. Trading, especially options, carry substantial risk. I do not warrant any expectation of return. I may or may not already have a position in stocks. I plan on taking trades if they execute, and I'm doing this not to provide stock tips, but to openly discuss how I take the trade, why I chose a specific stock or option strategy, and where I plan on taking profits or placing stops. So Devon, just to follow up on one of our recent picks, continues to go higher. This red dash here is R2, and we basically are stalling at R2. A sell signal came in. So I'm taking off another half, and I'll raise my stops up probably to my initial target and lock in gains. Still let some run because I think it could go higher, and I won't be afraid to go back in if the signals tell me to. This was for my, I believe this is Encana, and Encana also is stalling here at R2. Same, at R1 or at my target, which would have been the green line. I took off half and raised my stops to break even. At this point, I'm taking another half off because we're at a normal resistance point, and I'll bring my stops up to my original target, again, locking in and letting what I have left pretty much run untethered. WFT really did not trigger, so I did not take that trade. And then this was the long biotech ETF. Technically, it triggered, but then it gave a sell signal on the same bar. This on the weekly, and then on the daily, same thing. It triggered. This was we put the buy in. So technically, we triggered, and let me make sure I got what's right. Yep. And then it sold off. So this one, I sold it right away when I got the PPS sell signal, and I took a small loss. We'll come back to this week's chart of the week in a few minutes. Jump into TradeStation quickly, and I'll take a look at my market force and divergence. The NASDAQ, this is where I generate my market meter. You can see we failed at this. This was sort of my trend here, top of the trend, resistance line. We failed there multiple times. We now have a sell signal, red bar. The elder indicator is red. We've got a sell signal on the weekly with a red bar, and we're now in a sell signal monthly, but with a blue bar. NASDAQ's the weakest of the bunch. The Dow, also a red sell signal, red bar, but still in a weekly and monthly buy signal. The S&P 500, sell signal, red bar, weekly and monthly buy signals. And then the Russell 2000, as you could see, these red dots are MACD divergence, and it just calls out that we're getting long in the tooth, but it doesn't immediately lead to a change. Ultimately, we did have a sell signal come in on Friday on the daily. We're still in a buy weekly and monthly. So we haven't rolled over. We're near the tops of the range for most things except for the NASDAQ, which is diving the fastest. And we already went through the sector, so I'm not going to go through that right now. Let's take a look at the markets within HGSI. So let's go into Woodward and Brown user groups, Major Markets Plus, hit the warehouse, and let's do a pure price and volume ranking system that puts more weight on yesterday and a little bit less weight on for 1 week and even less weight for the last 3 weeks. No surprise with a weak dollar and risk in the market. Gold and silver are up. Commodities moved up with the weak dollar. The VIX moved up closer to the top, was up 18.8% in the last 5 days. And then growth stocks got hammered. NASDAQ, semiconductor, small cap, biotech, mid caps, NASDAQ 100, Russell 2000. So not a good week for those of you that were aggressively to the long side. Let's take a look at the S&P 500. So we did have some kahunas come into the market on Thursday's down day, but let's go into a clean view and take a look at what we think is going to go on here. So, I've had a lot of trend lines here wondering where this was going to stop, and I think we've rolled over. If I look at the weekly, it might be even easier to see. This was the line that I was watching, took out a couple of prior tops, and looks like we're failing here. So this is not a huge pullback. We've got the 50-day here, which would be a normal bounce point. We closed on the upper half of the day on Friday, which is okay. The weekly bongo is still green, which is okay. I think the S&P could run back up one more time before it's time to sell and go away. But let's take a look at the rest of the market because they may not all be so optimistic. Go from the S&P, let's take a look at the Dow. Looks just like the S&P, don't need to spend much time. Take a look at the NASDAQ. NASDAQ still is green on the weekly bongo. It's now pulled back to its 50-day moving average. You can see the OBV turned down. Worrisome, but a bounce at this point may still lead to a retest of prior highs, but this is really a line in the sand. I'm going to be watching that closely. And then the Russell, although it's got a similar looking pattern of a big run up and pullback, it's sitting right on top of the 200-day moving average. So on one hand, it's at a place where I might expect it to have great support, and I've still got the 50-day right under here as well, and the weekly bongo is still green. So looking at this, again, I have lots of concerns, but I don't see that the sky is falling and I have to run for the hills. But I'm certainly not an uber bull right now, and as I said, I took some contras last week to protect me for the downside. The dollar, as I said, was weak after BOJ. Thursday and Friday just falling hard. Its weekly bongo remains in a sell signal ever since it was up here. It struggles to get above the 200. And the VIX is starting to stir, and if the VIX starts going up from here, that foretells bad things for the market. But the VIX got held back at the 50, so I'll be watching the VIX as well. If the dollar is weak, gold is strong, and if you weren't a believer, and look, I was pretty bearish on gold for quite some time. And each one of these failures at the 200 really told me. We changed this year in the beginning of the year, and I'll have to admit I still had my doubts. But I've been very long gold in my portfolio now for a while. You get these little pullbacks here. You had another good opportunity to go back in here. I really do follow my weekly bongo, which is one of my indicators that I was involved in creating. And ever since we broke above this 50, which would have been an opportune buy point with the volume taken off, we went to a green bongo. So gold, this is gold miners, where it may actually be stronger than the S&P gold, but basically a similar pattern. And I drew this here again talking about that breakout. So gold, you got to be bullish. Now, how far does it have to run? See where we are on the high jump bar. We're not at the highest high jump. Did have a nice gap up here. 3 days. As Fitzpatrick says, the first day is the really smart money. Second day is the next smart money, and then the third day will be us. And usually that's the day that you get a reversal. So we've had a big move on gold, so be careful. But gold is certainly strong and suggesting it's got more to run. It certainly has built up a lot of energy to do that. And silver looks a lot like gold, and gold is caught up to silver. So, shows you where the strength is in the market. Let's take a look at the industry groups. See, we have 171 in HGSI. We have 6 groups to the downside: large pharma, cable, satellite, ag, chemicals, power generation, coal, and consumer electronics. Now, interestingly, they all have had good distribution, so this is a new reversal to the downside, perhaps. But let's look at what's working to the upside, and you could see that that's contracted to only 23. Let's see what we have. We've got a bunch of things that have been moving since February 11th. We have metals, oil, gas, and steel. Metal, steel, utilities, as I said, turned around this week. Internet media, Facebook, midstream, packaged foods, utilities. And beverages and tobacco, a lot of defensive plays, and a lot of those junk off the bottom stories. If I right-click on precious metal minings, take a look at some of these. American Barracks looks great. I believe it's breaking, is that its 1,000-day moving average? Let's see. Yep. This stock is now breaking over the 1,000-day moving average. Gold is back. Let's switch it to my more favorite view. These things popped on Friday, are probably going to get extended. You could see this is at its high jump. Everything is green. As good a pattern as we could see. It's up from the beginning of the year 162%, so it's had a huge run. That's American Barracks. Newmont Mining, Gold Corp, this is the one that I'm playing. It's up 74% from the beginning of the year. All of these are extended. This is my high jump indicator. When it gets to the top, it tells you that its extension from its moving averages is the highest it's been in 200 days. You go back here and you could see that it ultimately pulled back a little bit, although it really took some time. I'm not too worried about it. This thing has been compressed for so long, and it's going to be dictated by the dollar and the gold price. As long as gold is strong, these stocks are going to do well. AEM adds a little nickel and steel, same pattern, and then silver, wheat. And so they've all had a run. I think you're probably in a bunch of them. Some of the smaller ones may still be very attractive as well. Oil and gas services. This is a stock that's ugly, but looks really interesting. 5% dividend yield. Ignore the earnings because it's a turnaround play with energy turning around, one would hope. The group is strong. My weekly bongo went green. We had a kahuna on Wednesday, good value, and on a bad tape, this was a strong stock. National Oil Well, Varco. Superior Energy Services, a similar pattern, broke above the 200 after a profound downtrend. Everything is green. Doesn't make money, pays a 1.9% dividend. Baker Hughes, I probably would skip this one because I can't figure out what's going on with Halliburton. It may actually move up if that merger falls through. Schlumberger, this is one that I own, although I'll probably look at some NOV. Nice move off the bottom. Its earnings were tepid, still makes money, and pays a dividend. I think now people are playing these things for a rebound. So, compared to a lot of things, these things look strong. They've all had big moves, and their fundamentals are not necessarily great. Here are 3 stocks. I'll just go to the ones above the index that have been big movers since the bottom. So change since the beginning of the year on Cliffs, 233%. It's still a $5 stock. Doesn't make money yet. Things may be improving, selling some assets. If these guys appear to be survivors, which when this sounds like it is, one would expect them to continue to move. They've had a big run already. Here's Vale, sort of the same stock, but Brazilian, same chart pattern, up it's up only 72% from the beginning of the year. And Rio Tinto up only 15%. So these stocks look strong, as do steel stocks and the supporting stocks. Base metals, I'm in these. This one is so funny. Freeport-McMoRan is up 106% from the beginning of the year. They got hammered. Not only were they a gold and copper stock, mostly copper, I think, historically. A couple years back, they bought a bunch of energy assets at the peak. Timing is everything. All those energy assets are probably a positive. They're probably still going to spin them out. Every day, there's a new sell side analyst report coming out telling you to take profits and sell the stock. OBV continues to be strong. Everything is green. Every day, it sets a new high since this downtrend reversed. I have taken profits several times, and I'm sort of in the small position letting it run phase. Here's my Techminco. This was a good time to buy. This was a good time to buy. It's hard to say I should buy it now, although when you look at it on a longer term chart, if it can run up to its 200-day, which I don't think is out of the question, that's still another 75% move from here. So Techminco's been great. And the reason why I called it out the first time was that I was fortunate enough to buy it back on the bottom in 2009, and it did the same thing then. I don't think it necessarily goes up to 60 again anytime soon. But this has just been junk off the bottom. This is, you pick the ones that you want to play. In Alcoa, despite bad earnings, nice move up after earnings. Its story here is it's splitting itself into multiple companies. I don't know enough about the story to comment on it. Steel producers. Here's another stock that I'm playing just like Freeport-McMoRan. I've been buying it off the bottom here and taking profits. A little bit of a pullback. This is one that is actually perhaps at a buy point, and this is sort of my get on a plane setup. It's not in a squeeze, but it has pulled back to support on the 17-day moving average. It's right below the PSAR. This one looks like it might be one to play again. Steel Dynamics, this has had just a beautiful run up. I wasn't smart enough to play that one. Integrated Utilities starting to make a move. This is an expensive one, but the charts actually look pretty good. They've retaken the 50 mobile breakup from a squeeze, recent kahuna. Dominion Resources. You notice in all of these, through Detroit Edison, not DT Energy, that Bongo just turned green. They paid dividends 3 or 4%. Here's Duke, 4.2%. Probably sitting on good buy points with pullbacks to their 50. If there's a lot of entropy in the markets, this might be a good place to play. Internet media, well, this is about Facebook, Baidu, and LinkedIn, so let's look at them. Facebook, massive blowout of earnings, Bible gap up. According to Bible gap up rules, you probably would still be in this stock. It's probably not a bad time to buy it. I would set my stop at the low of the day on Friday, maybe give it a little bit more. Let's see. It closed at 116. The low is 115.84. The low on that was 116.23. I'm in Facebook. I would buy it again if I wasn't in it. Obviously, I'm touting a stock I own, so take that with a grain of salt. Everything has turned green. Analysts have been raising estimates. I wouldn't let it drop much below the low of the gap up bar, and that would be the one thing. This was an ugly move here where it sold off throughout the day, but it still maintained the huge gap, and it's in the setting of market weakness. I thought Friday was a positive day. I like Facebook here. I'm still in it. Baidu, you could see traded up and came back, closed middle of the road Friday. Bible gap up, mobile breakout from a squeeze and a kahuna. Fundamentally, it doesn't, well, had a great quarter in December. Earnings came out, which why the next earnings are not to July. Less extended than Facebook, might be worth looking at. In LinkedIn, I don't like its where it sits way below the 200. It was a nice trade on earnings. You can see the weekly bongos far red, and probably wouldn't be playing much there. Midstream oil and gas. I don't have one of these, and I think I need one. So let's just look through at a couple of these charts. 9% dividend, Target Resources coming up to that 200, which might be resistance. Negative earnings, don't like it. ETP, I think there's some M&A activity on it. Coming up to its 200, it pays 11.9 dividend. Tallgrass, this guy came out with earnings Friday. This might be a place to play, 6.9% dividend. Big kahuna, as I said, earnings came out on Friday. Williams Partners, WPZ, 11.2% dividend. Good earnings per share growth. Closed above the 200. I like that one better. Magellan, starting to move, 4.5% dividend. And then Sunoco Logistics, sort of a flag after breaking above the 200, and it looks to me like it's ready to break out above the flag. Pays a 6.6% dividend. I like Williams. I like Sunoco. We'll come back to Sunoco. Packaged foods. Now we're talking defensive. Probably run too far for me to play B&G Holdings, but a Bible gap up, closed at the high. Pilgrim's Pride. Hershey Foods. So these are consumer staples, and these were things that had nice runs earlier in the year. Tyson had a big run, still got decent earnings per share growth compared to its multiple. Earnings not to May 9th, so that's pretty close. I'm not a big fan of these stocks, but if the market is going to roll over and you want to be long, they may be a good place to stay. And then we'll look at some more networks really quickly, more utility networks real quickly. And you could see, again, pull back to support in moving mobile breakout from a squeeze, PPL, 4% dividend. That looks interesting. National Fuel Gas in a nice little uptrend. Edison pull back to support. I think these things almost behave as a wolf pack, where if it's the market is favorable for utilities, they all move at the same time. So where are my utilities? They're probably right in front of my face, but let's see if I can't find them. As you can see, almost all of them move together. When I see that, it tells me that the big money is buying utilities. All right, that's the top 10 groups. I have to admit, wasn't as exciting as some of the others. Now, I also do some of my own scanning work that I will do in various platforms. So within HGSI, I always like to go up and look at stocks that are at free parking, which is the 50-day moving average showing momentum, and see if any of these look interesting. 3 of them are bonds. That doesn't say, this is a takeout, skip it. Don't like it, it's too choppy. Pays a 3% dividend though. Let's look at this on a weekly. Is it a newbie? So it's a stock that had gotten killed, had a gradual move up, nice move up over the last 8 months. It's pulled back to the 50, had 3 kahunas out of 4 days, mobile breakout from a squeeze. Doesn't make a lot of money. I probably would pass on this, although I don't mind the pattern. It's a little loose because it doesn't have enough volume for me. And then I got a bunch of bonds. So I'm not seeing anything in my pullbacks with momentum scan. Then I look at, let's expand it to 2%. Hershey's we already saw. It doesn't really add much. Then I have the scan here, which is a PSA reversal close at a squeeze. This is one of my favorite ways of finding good stocks. That Hershey showed up again. So we're going to go look at that. Look at these. I'll show you why I like them. Uptrend, sideways, it's in a squeeze, and the PSAR dot gives me a logical target to set a buy point. Westar Energy, nice sideways squeeze. Here's a utility, pays a 2.9% dividend, 1.4 million shares. Problem is earnings come out in a couple of days, sitting at a natural buy point. Edison International, talked about this one already. Mobile breakout, right below the PSAR dot. It's sitting at a natural buy point, pays a 2.7% dividend. Now, why do I keep saying natural buy point? Look at the stock on Friday. There's a Wells Wilder reversal trading system that people probably use still. And when this stock goes above $70.80, there's going to trigger a lot of buy signals. I like that. It's pulled back to support and had momentum come in. Mobile breakouts from a squeeze. I like that. It's in a volatility squeeze, which means it's setting up to move. I like that. Here's the other thing I like. If it's in a squeeze, it's probably going to have a tight stop. I would put my buy right above the PSAR. So say among friends at $71. I probably put it at $70.90. I put my stop probably in the bottom of this day here, maybe at the doji day, which is 68.65. So 71, 68.65 is $2.35, which is about 3 or 4%. That's a very tight stop. And there's another word for this stock here. Let's go take a look at it, EIX. And those that have been here before better say high close doji. And then I hope it really was a high close doji. So let's look at EIX. It was a high close doji 2 days ago. This could have been my buy of the week. Strong OBV on weekly and daily, PPS buy on the weekly. On the daily, it had a PPS buy on the weekly, and that's why I didn't pick it. It's because of this pullback. I think it's ready to break out. I do like Edison. So this is how you should be using scans, is to have the best stocks come to the top. Treehouse right below PSAR dot, sideways move in a squeeze. I don't like the mobile breakout to the downside. Squeezes can go up or down. That's a takeout. And here's Hershey's, just too loose for my taste. So other way that I do my scans is I scan in TradeStation, and I have a number of scans that I run. I'll just show you a couple of these scans and why I find John's stuff to be so useful to me. As I said, we're a little bit over an hour. I'll continue for a few more minutes. A PPS buy one signal. That would be a stock that has a new long signal with John on the daily, while it's also in a buy signal on the weekly. So the weekly could have been in the past, but these are stocks that have both daily and weekly buys. You can see the OBV is strong here, and you can see Facebook came out its earnings. It was in a squeeze, and it had a Bible gap up, pocket pivot, mobile breakout, PSAR reversal, and a kahuna force. It had every positive signal I fire on Thursday. So I scan here to find stocks that have new buy signals. And the reason why I want the weekly signal to also be in a buy signal is I want to find stocks. Let's go look at CPN and HGSI chart world. I want to find stocks. Cheryl, I'll be done in about 5 minutes. Okay. I want to find stocks that are in uptrends, at least intermediate term uptrends, that pull back and get a new buy signal with momentum. So I get that with the buy one. The buy two are stocks that have the same story, but these are at support. So it turns out that Baidu was at monthly pivot support, the blue line, the day before, and it had a buy signal and a gap up off of support. Baidu, as I mentioned, was very strong. So it looks at the entire 8,000 stocks. I put a volume and a price limit on it, and it finds me stocks that look like Baidu. Buy signal 3, daily buy near pivot support. So these will be stocks that have a daily buy, but they might not be in a week. They might be in a weekly sell signal. All right, I don't know if this is or it isn't. So sitting right on support with the buy signal. I actually looked at this. This was a healthcare stock, if I remember correctly. And then buy 4, all the buy signals. So this week we had only 42. Is that it? Daily buy signals. If I look at sell signals, same story. This would be a sell signal occurring in a stock that's in a weekly sell. So let's look at retailers because they looked horrible. Chico's. Breaking down here. So this one's at support, so we're going to see that again. But we have a daily sell signal and a weekly sell signal. So if I was looking for stocks to short, I might look there. So where we had 42 longs, we have 90 shorts. So that tells you what market, well, wait a second. I've got to look at that one. We have 370 short signals come in. That tells you the market's weakening. Sell signal 2, daily sell near resistance, weekly in a sell. As I told you, we'd see this again because it's sitting right under resistance. If I wanted to look for shorting stocks, would I want stocks that are in a longer-term downtrend that pulled up to support and got another sell signal and OBV is breaking down? Absolutely. Sell signal 3 would be just a daily sell signal near pivot support, but we're still in a weekly buy signal, so that might be a less high probability signal. And then lastly would be all sell signals. So that's the first thing I scan in TradeStation for. Then I talked about that high close doji, which is John's best, most positive for me signal. And I have a high close doji, all comers on the daily, which was 29, or if I only want those that are in a daily buy signal. So this should be only stocks. Here's a food that we looked at, BG Foods. These have to be stocks that are in a daily buy signal. And this already was in a daily buy signal. You can't see it. It's right under there. Let's see if I can bring it up. Now, that little thing there is, there's a daily buy signal right there. You can see the tip of it there. So you're in a weekly and a daily buy, and look at the OBV firing up on BGS. So I'm finding stocks that had this high close doji, which I'm not going to go into the definition and how I trade it, but it's a super powerful reversal signal. And this is a stock that's been in a downtrend. Let's look at MMSI. So here's a stock that's been in a downtrend, but it's had a high close doji, but it's still in a daily sell, so I probably wouldn't take that trade. If I look at the next, hold on a sec, did I do that wrong? Yeah, so this is a daily high close doji, but the weekly here was in a buy mode. That's what that scan. If I look at monthly high close dojis, these are my favorite pattern. And what I look for here are stocks like, let's go to Sunoco. Which one do I want to look at? I like looking at things that I know what I'm going to find when I look at it. Well, let's look at Bristol Myers. Oh, that's monthly. Skip monthly. Monthly, I don't play with much. I probably should. On HCD weekly, these will be stocks that have a high close doji on the weekly. My best performers will be stocks, that's why I didn't see what I was looking for, that like, let me pick one that I know looks good. I got to find one that's in a down golf pour. Nope. I'm looking for stocks in a downtrend, and this doesn't filter for downtrends. So let me very quickly see if I can find one in a downtrend. You notice the orange bar on the weekly. That's a high close doji. So I will scan the market, and I will look for stocks that are in a downtrend. This isn't much of a downtrend, that have a doji, and then within the next couple of days close above the doji. And I look for those stocks with strong OBV breaking out. And that's where I find my big winners. And most of the ones that we've reviewed over the last couple of months that have won have been stocks in this pattern. You know, we've been in a big uptrend, so it's a little harder to find stocks in a downtrend. A high close doji occurring in an uptrend is not a bad thing by any means. It's just more meaningful when it's occurring in a downtrend. And most of these stocks have had a big run already. But this is why you scan. You scan to find high probability targets. Then, for example, low close doji weekly, I can find stocks that may be telling me I don't want to be going there. So here's a stock that has a low close doji and a PPS sell signal, OBV breaking down. So I use my scans to help me find high probability stocks to trade. Now, the lifetime package isn't cheap. It's $34.95. The Devon trade made enough to pay for it for the entire year. Or, excuse me, the $34.95 is lifetime. You can get it cheaper on a monthly basis, but you get all in on the lifetime package. If you have interest in it, and I can get enough people with interest, I can go and beg for something better. But first, email me if you have interest if you don't have the package, and we could talk about that. By the way, I get no commissions. I get nothing if you buy it. If you go to anybody's live meetings, I just like to help out my friends. So let's go back, show you the stocks that were the ones that I was most interested in as we go into this week, and that would be my filtered buy list. So I'm going to start with that. Let's go look at this list in TradeStation. All right, here we go. CBD is, I think, an international bottler. I think it's in the consumer staples. You'd have to go back and look. It's Brazilian. Brazil's had an interesting move with their impeachment or attempted impeachment of their president. In an uptrend already, a little bit of a pullback. Had a high close doji a few weeks ago. OBV is strong. A new PPS buy signal came in on Thursday in a bad market. It looks interesting. HBM, I like this one. This is Hudbay Minerals. This is a cheap gold miner. If you're looking for a gold miner that's cheap, this one's breaking out. It had a PPS a week ago. It's been in a PPS daily for some time. It's already run some, as have all the gold miners. This one looked interesting. MEMP is too cheap for me, but it really had a lot of things I liked about it. It's Memorial Production. It's an exploration and production company. Why do I like it? It's clearly been in a downtrend. As you can see, the descending 200-day moving average clearly has been basing for some period of time. It had a high close doji on Friday. OBV has broken through its moving average. On the weekly, daily, it's strong. It's in a daily PPS. If it wasn't a $2.90 stock, trades a lot of volume, this would have been my pick of the week. TEP is Tallgrass Energy. This was the MLP that had already reported at a nice breakout. TYL, I think this is an electronics company. I don't remember exactly, electronic parts. Downtrend, high close doji, strong OBV, PPS buy on both. This could have been my buy of the week pick. Maybe it should have been. The reason it wasn't was it's a $138 stock, $140 stock. I'm not sure any of my video watchers can buy a lot of it or enough to make a difference. And UVE is a universal insurance. If interest rates rise, insurance is strong. And again, this is another one that could have been my pick of the week. PPS weekly, it's in a PPS daily. OBV weekly, OBV daily are both strong. It's coming out of a squeeze with a high close doji on the daily. I have a number of stocks there that could have been our purchase for this week. Here's the one I picked. Let me go look at it first in HGSI, and then I'm going to come back. I decided to go with Sunoco Logistics. And the reason is MLPs made the top 10. It pays a 6.6% dividend. It has broken above the 200-day moving average, formed a flag, and looks to me like if I can get above my point there, it's going to take out the flag. And I think it can go even further. Another 4 to 6 points would be my target. Love the dividend. It's got earnings per share growth coming into the stock. A big caveat, earnings are this week, so you may want to wait till earnings come in. It's got a pretty tight stop, so the problem is, as we all know, earnings gap against. Others in its group have been reporting and doing well, and as long as they maintain their dividends, I think it's going to be fine. So looking at it here, everything's in green. Mobo breakout. I really like this holding at the 200. And now let's go look at it in TradeStation. I had a high close doji a week ago. Didn't do much this week. It's in a PPS weekly. Little bit of a pullback on the daily, then a high close doji on Friday in a PPS daily. OBV straight up on the weekly. OBV strong on the daily. Coming out of a weekly squeeze. I see a lot there that I like. So back to my PowerPoint chart of the week. Again, this is for demonstration purposes only. Trading involves risk. You and you alone are responsible. So here's the SXL. I already showed you why I liked it. So what I did is I looked. You can't see it. Let me go back into TradeStation and point something out. This here is something called the last conditional change. And it's sort of the trailing stop extraordinaire of John's work. And the fact that it's gray tells me it's the trailing stop on this downtrend. This white is the last conditional change, trailing stop on the new move up. So I'm going to basically trade it if it goes above this stop here, and I'm going to put my stop right below here. It's a very tight range. So let's go back to my PowerPoint presentation and show you that I'm going to put my buy stop just above that last conditional change at 29.72. That also takes out the high of the flag, and if this is a flag, and here's the pull, maybe I'll get a big part of this run up on top of it. But even if this is the flag, I'll hope to get, here's my pennant, a big move up. So I'm not going to take this stock until it trades and probably closes above 29.72. My first target is 31.84, which is up here, or it's over here on the green. And my stop is right below the white last conditional change at 27.60. That means I'm risking $2.12 per share, or 7.2%. I'll buy close to 1,000 shares for every 2,000 I'm willing to lose, and that will be my trade if it triggers this week. Lastly, if you like the things that I do, I highly recommend you buy both HGSI and John's Indicators. If you own John's Indicators Lifetime already, or if you purchase them, you can be a member of the PUG group. At least the first year is free. We're still working on some goodies and opportunities for going forward to be announced later, new indicators and things like that. That gets you, if you have those two packages, you essentially get everything that I used on my webinar today. Remind you about the fall seminar with my meeting beforehand. hgsidoc@gmail.com is my email, and I hope to see you in Florida. Sorry, I was a little bit disjointed because I kept getting calls from my business partner. Have a great day. Goodbye.